Hello, everyone, and thank you for joining us for another episode of the Money and Mindset Podcast. I am your host, Sharika Alford, here with.
Anntricia Bray Smith.
We're here to provide you with motivation to get out of debt, build wealth, and transform your outlook on life. Today, we will be joined by Parthenia Walker, and she's going to help us understand the difference between term and whole life insurance. Parthenia has over 10 years' experience in the financial industry. She's a financial controller at a real estate company here in Oklahoma, and she's also a financial educator with the National Campaign for Literacy. So, Parthenia, go ahead, take it away.
All right, let's talk about proper protection. Okay, so the differences between term and permanent. Okay,
Permanent,
so
yes.
yes, term and permanent. So we're going to talk about the two different ones. So let's start with the easier one. Okay, and feel free to jump in with any questions. Term insurance is a life insurance that covers you for a specific term. Okay, so whether it's 5 years, 10, 20, or 30 years. So you have that coverage for whatever amount you're purchasing for, let's say $500,000, and you're covered for those 20 years if you choose that. Okay, typically this term insurance is the lower cost insurance. Okay, because you're just paying for the cost of insurance for your age group. Okay, so
Okay.
that is the most least expensive one. But once that term is over with, you either have to renew it, okay, or renew that same policy or get a different policy. So we're going to talk about the difference first, and then we're going to talk about the pros and cons of both. Okay, so the second one is permanent insurance, type of insurance with permanent. So under permanent, there are different types of permanent insurance. Okay, there's whole life, there's index universal life, and there's variable universal life. Okay, so permanent insurance does exactly that. It covers you for your entire life. Okay, so it's not a temporary term that you're covered for. So let's start with whole life. Whole life is, I like to call it the dinosaur. It's been around the longest, okay? The dinosaur of insurance. But you have a set amount of money you have to pay, okay? And with permanent insurance, there's a savings portion, a cash accumulation portion of that type of insurance. So you're putting money in, let's say your monthly premium amount is $100, throwing a number out there. Part of that $100 is going towards the cost of that insurance protection. And the other part of that premium is going to cash accumulation. Okay, so with whole life, it's a set amount, set number, and you get a very low interest earning on that cash accumulation side. Okay. The second type, let's talk about a VUL, a variable universal life insurance, covers you for your entire life. Part of your premium goes to pay for the cost of insurance, but the other part goes into the cash accumulation side, which follows it's just like you're investing money. Okay, so you're putting money into the market with a variable universal life. So if the market does well, you get whatever the interest rate is, the gains on that. But if the market does bad, you do lose money in that cash accumulation side. Okay, so it's just like you having a regular like mutual fund. It follows just like that with a VUL. Okay, and then the last one I want to share about is the index universal life policy. Okay, again, covers you for your entire life. Part of your premium goes into paying for the cost of insurance, and the other part goes into the cash accumulation side of it. And this one follows a specific market index. So a market index is just like the S&P 500. Okay, so within this particular cash accumulation, it follows the index, but there's a cap and a floor rate that you can earn. Okay, so with that, in an index universal life, you may have a cap of 13%. So if the S&P 500 gains are over 13%, you are only capped at 13% in that cash accumulation side. If the market does bad, it drops, whatever happens, presidential election, whatever, it drops in an index universal life. Most of those policies have a 0% floor, meaning that your money is locked in at 0%. So when most people are losing money in your account, you won't be losing it. It's whatever. If you have 100,000 in there, you will stay at 100,000. Okay. So those pretty much the overall how it works. Okay. So what are the pros and cons? Okay. Pros and cons. Let's talk about term insurance. All right. I feel like I need a board for all of this, right? Okay. Term insurance, again, is a temporary coverage. Okay. So let's say you are a 30-year-old woman that bought a 30-year policy. Okay. A term. So you're covered for 30 years or whatever amount. So let's say you're now at 30 years old, purchase it, you have it for 30 years, you're now 60, okay? You're 60 years old now. In those 30 years, okay, if your health changes in any way, okay, after those 30 years of that policy is up, you may not re-qualify for that particular insurance, okay? So if for whatever things may happen, most companies, you won't be able to renew it. Let's say, okay, nothing happens to your health. You're good. You're 60 years old, and you would like to keep that policy. You want to renew it because you don't have enough savings saved up for your family if something was to happen to you. Okay, now you're 30 years older. Okay, so at 30 years old, your policy maybe cost you $20. But at 60 years old, that same exact amount may cost you 50 or 100, or because you're closer to the mortality rate. So we're estimated to live to 88 women. Okay, we live longer than men. Okay. I don't know why I think men, because they do kind of crazy stuff sometimes. I don't know. But but we're estimated to live 88, okay, years old. So when we're closer to that age, our insurance skyrocket. Go ahead.
Hey, right now we just estimated to survive COVID, okay?
Right. First thing, survive COVID.
I couldn't resist. I couldn't resist. Go ahead.
No, you're good. Yes, first thing, women and men survive COVID. Okay. Then, okay, we can live past to 88 years old. Okay. So, of course, when you're closer to that age, the mortality rate age, the insurance cost of it will skyrocket. Okay. So it could be, like I said, from $20 to $50, and it could be even over $100. Okay. These are just, numbers off the top of my head. Okay. So to me, those are the cons of a term insurance. The pros of it, though, is when I first started working towards my personal journey of building up my solid financial foundation, I was 24, 25 years old. And of course, I was start paying down my debt, number one. So all my extra money was going towards paying down debt. So I couldn't put money into a permanent plan. So I opened up a term plan. It cost me $15. That's 2 meals at Chick-fil-A, okay, for that. But I knew that I was protected, of course, okay, for my family. If something was to happen to me, my parents would be taken care of. All right. So that's a pro. It's low cost for someone that's starting out their journey, okay, right away. Now that to flip it on the other side of the thing, okay, that term policy that I purchased at 24, 25 years old, I actually converted that into a permanent plan. Okay. Now I'm a professional that believes that there is no one size fit all, okay, plan. All right. So everybody's plan will look totally different.
Thank you.
All right. So I'm just sharing my story of what I did with it. Okay. But again, you may have a totally different plan or goals than I had. Okay. So I actually converted my term into a permanent plan, and specifically an index universal life plan. Okay. So pros for a permanent life insurance is, of course, it covers you for your entire life. So it's guaranteed to pay out as long as you're making your premium payments. So I know my parents, my family, now my husband will get that payment of insurance when God calls me home. Okay. Now, a con of that is it costs, the actual out-of-pocket cost for you will be much more than the actual term. And the reason being, of course, you have your cost of insurance because it's covering you for your entire life. All right. The insurance companies have to recoup some of that cost because that's going to pay out to your family. Okay. So it's going to cost a tad bit more, okay, than a term insurance. But also remember that some of that out-of-pocket cost will be flowing into a cash accumulation. Okay. So depending on the strategy that you want to use, whether it's a set fixed amount, okay, which is a whole life, or you want to take some risk in your earnings, that's a variable universal life, or you don't want to take too much risk, you don't want to lose money, but you do want to participate in gains, please do an index universal life, okay? So I wanted that for my future. I wanted to have, take account for the gains, but I didn't want to lose money as well. So that's why I converted mine from a term to an index universal life. But of course, my out-of-pocket cost went from $15 to the minimum for mine was maybe $80. Okay, but I started putting in 150 because I wanted money to go on the cash accumulation side. And then as I got more involved with the campaign, start paying down debt, I increased that amount. Okay, not that my cost of insurance increased. I just wanted more money to go to the cash accumulation side. Okay, I hope that makes sense.
Yeah, it does, and we appreciate you for giving us a background education on that, which is more in depth because we're taking baby steps with this. We've already dripped in some education, and you've come in and just kind of smoothed it over and put the icing on the cake, so to speak. So we
Here we go.
appreciate that. What I want to know is for that young mother listening. Young mother listening, when do they need to start thinking about a plan and what works for them, and not only for them but for their kids as well? Because I'm big on first, when we have young women in the family that are having kids, hey, as soon as possible, get a policy on you and your family, and then, hey, let's start some kind of savings or investments for them by the time they're 2 or 3 years old. So, in your um, expertise, in your field, in your uh, wisdom, what would you tell that young mother listening in just by circumstance that just happened to pass this podcast, and something you've said to educate them has resonated with them? What do you tell that young family?
Yeah, absolutely. Well, as soon as someone depends on your income, get an insurance policy. Okay. If it is, so you're a single mother, all right, single mother, there are plans, specifically there are term plans with certain companies that allow you to, of course, get a term of insurance, so 30 years, let's say, to cover you, give your kids enough time to grow up, okay, and you that 30 years the kids are grown up, they're out the house, but that term policy does have what we call living benefits available to it. So let's say you do have a health scare, okay, and you need money to pay for doctors and stuff like that. There are term policies that allow you to access certain percentage of your face amount. Okay, so now you're covered for in the event of premature death, but now you're also covered for life. Okay, if something was to happen to your health, you're able to access some of that money. Okay, and the term insurance, low cost out of pocket, and you're also able to add your children as a rider to that particular policy and cover them as well. Okay, that is a good start for it. Okay, and as you start earning more money, start paying down debt, freeing up money in a month, okay, there are other plans where you can start putting money to the side, whether it's a mutual fund or an insurance policy for your children. Okay, so as you're starting that process, start with a term with living benefits, protect yourself, and then start working towards the other thing, free some money up, and there's other avenues for you to do that. So good.
Now, Parthenia, tell us if someone wanted to contact you to find out more information and kind of discuss their personal situation, you know, to help them come up with an individualized plan, how would one go about doing that?
Yeah, so you can go to bit.ly /Parthenia. That's Parthenia. And you can schedule a time with me via Zoom. So no, I'm here locally in Oklahoma. So if you're in other states, you feel free. I can reach and help you as well. Schedule a time that works for you, and we can go through your situation. And I don't charge for this service, you guys. So if you're just wanting to see what you have and what options are out there for you, feel free. Come on. I want to make sure that our community is helped. Just feel free to reach out to me.
You
Oh, that
guys
is
are
so
listening to
generous.
the Money and Mindset podcast with Anntricia Bray Smith and Sharika Alfred. If you're just joining us today, we're talking about the difference between term life insurance and whole life insurance with our special guest host today, Miss Parthenia Walker. She has just given us some knowledge, guys. She has taken us to school in regards of the pros and the cons of what those insurances look like. So if you're just tuning in with us, make sure that you go back and you catch the replay on this as we're wrapping up today with the Money and Mindset podcast.
Yes, and thank you so much, Parthenia, because you gave us like just dropped all the jewels to at least get us to start thinking and considering what it is that we need to look into. And just to reiterate, of course, there are pros and cons to both. One being the time limit that each type of insurance, whether it be term versus permanent, you know, term just being the set limited time, permanent being for the duration as long as we're paying the premiums. And
Pay your
you know,
bill.
yes, yes. And so, you know, there's a difference as far as time concerned, and yes, there's a difference as far as the premium that we're paying. But yes, please do reach out to Parthenia, and she can go into a deeper dive and explain this information to you to help you decide what's best for you and yours.
Oh
Um,
yeah, and I'm just sitting here thinking something is better than nothing at all. You know, because
And
uh,
yes,
we're either going to sacrifice a few dollars a month to make sure our family is covered, or we're going to sacrifice uh, being in multiple uh, dollars of debt in the event
yeah.
something happens to one of our loved ones. So let's be proactive. Let's be intentional, which is some of the words that you can find in the proactiveplanner.com with Miss Sharika Alford, her blog. But guys, let me just say, we have to have a plan in place. We don't know what tomorrow, we don't know what the next second may lead us to. Talk to somebody today. It doesn't cost you anything to have a conversation right now today. She's just saying she didn't charge for those services. And not only that, if you don't want to talk to her, look for somebody local. There is
Yes,
somebody in
absolutely.
your neighborhood right now that you can talk to. It starts with the conversation. Anything we do is going to start with a conversation. You may not do anything until next year, next couple of years. But unless you have the conversation, you don't even know where to start. Have the conversation now, begin to put a plan in place, and be proactive in protecting not only you, but your family as well.
all right, guys. Well, that's it. Thanks again for joining us, and until next time.